Okay, can we all agree that the stock market has absolutely lost its mind? For context, yesterday was the Fed meeting, which we will talk about that a little bit here in this video because that is partly why we are dropping so much, with the Nasdaq down about 5% at the time of recording this video. Well, yesterday the markets rallied 3%, the S&P 3%. Nasdaq, it was like 3.2% positive after that. That was the single largest day of gains on a Fed rate decision day. So that was a very historical rally. Now you're seeing a very historical sell-off in the markets day after the Fed, but also in the bond market, which is helping to drive things down, which we're going to talk about all of that. But I want to point out something that is very obvious to me. It's probably very obvious to you guys as well. But Sofi stock is down 4.31%. Look at Square, down 11.5%. I think personally, this is a sign that Sofi stock is getting to very attractive levels on a wide range of different hedge fund metrics, right? Some hedge funds, some money managers, they're going to like Sofi at these prices, but some are not. But I think you're getting down to a comfortable level where it's like, it's not even worth shorting anymore. The shorts have completely taken over SoFi, but I think we're getting to a really nice level, and I think the price action, especially today, is showing us that. So we have a lot to talk about. The work is cut out for us here in this video. We are going to make this drop make some sense to you guys and go over exactly what's going on. So hit the like button and subscribe to the channel if you guys find value out of this video. Consider sticking around a while. Now, first things first, we did get some data that came out today that is very important for you guys to know. And if we do go pull up good old CNBC, you see the Nasdaq is down 5.18%, absolutely ridiculous. Dow Jones down 3.23%, S&P down 3.7%. Ugly out there. But it says worker output fell 7.5% in the first quarter, the biggest decline since 1947. Worker productivity fell 7.5%. At the same time, labor cost as measured against productivity soared 11.6%, bringing the increase over the past 4 quarters to 7.2%, the fastest rise in about 40 years. Weekly jobless claims increased to 200,000, well above the Wall Street estimate. Now, as you guys probably know, bad economic data was kind of seen as a positive thing over the last couple of months. The day the news came out that GDP in the first quarter dropped 1.4%, the S&P climbed over 2%. I personally did not expect that, even though, bad news was seen as good news. Well, now any potential economic bad news is seen as really bad news. Why is that? Well, the Fed was asked a direct question yesterday, and Fed Jerome Powell, to be more specific. He was asked, what if economic data starts to not look so good? What if we really do head into a recession? What if unemployment starts to go up a little bit? Would they stop raising rates or stop raising them as aggressively? He said, well, we're not going to take into consideration, a single data point. We would basically wait to see how the data does evolve. But he said that they would absolutely not stop raising rates. They might not go as aggressively, but he was saying basically expect this to continue, these 0.5% rate hikes and potentially 0.5% rate hikes throughout the rest of the year, regardless of what the data looks like. So what you're really heading into, and what the fear is right now, is that maybe the economic situation gets worse. Maybe there is real demand destruction, and that basically means prices just get so high, inflation is so bad, you destroy demand. The Fed also helping to destroy demand. And that's part and part why the banks have not been doing so well, is the fear of the consumer slowing down. It doesn't even matter if rates going up is supposedly good for banks. If there's no consumer that wants to take your money, it's not so good for the banks. So that's a big point. As well as in Europe, you did have some news about the Fed not really seeing eye to eye over in Europe. About half of the members do not want to raise rates. About half the members do want to raise rates to fight inflation. Keep in mind, Europe is virtually in a recession. I'm sure they're in a recession right now. Once Q2 GDP comes out, you'll actually see if they're in a full-blown recession. But there's a lot of division over there. So that was obviously not good. And what Fed Jerome Powell was saying about the rate hikes comes down to TLT and the Treasury rates, the yield you can get on some of these rates. TLT is down, and this is the 20-year Treasury bond ETF. It's down 3.61% today. So when this goes down, interest rates actually go up. And for everybody, that hears the headlines like the Fed just raised rates 0.5% like they did yesterday. Yes, but that is the federal funds rate. That is essentially the rate, say, Bank of America needs to borrow money from a JP Morgan. That federal funds rate is the rate that Bank of America would have to pay to JP Morgan to borrow some money overnight or for a couple days, whatever the case is. That's the federal funds rate. It really has nothing to do with the rate that you guys pay for loans, for car loans, for home loans, for student loans, for any kind of loan. It all comes down to really treasuries, because I like to make this analogy all the time, but would you lend me money for, say, 5% when I have, call it a 30% chance of not paying you back, or even a 10% chance of never paying you back? Or would you lend the government your money and get a guaranteed 3.088% return? Obviously, you would lend the government that money, right? Because it's risk-free. Now, this is basically saying that the markets are projecting much higher rates into the future. The yield on a 10-year treasury went from yesterday's price at about 2.88 to 3.086 today. So this is a massive jump, and this whole chart looks like a momentum stock at this point. Like little short squeeze after little short squeeze. And this is ultimately not good. This is driving up real rates, like I said, that you and I would pay for things like auto loans, for things like home loans, student loans, things like that. So it's pretty interesting mixing all of that together with even what Sofi is doing right now, only down 4%. It's looking pretty positive on a day where the NASDAQ is down 5%. Am I allowed to say that Sofi does look pretty positive on a day where the NASDAQ is down 5%? I don't know if I'm allowed to say that. I know a lot of people are losing money, and it's one of those very unfortunate things, but we'll get through it, and things will be all fine in the end. And people that bought the dip, I believe in Sofi, will be rewarded very, very nicely over the next coming, months and years. Hopefully not, 5-10 years, but even if it takes a year, I think things will hash out very, very well. Now, what else is causing the market to go down? It's simply due to the fact of Fed Jerome Powell and his wording as well. Something that really stood out to me, or caught my eye, whatever you want to call it, is Fed Jerome Powell really kind of pushed back on the whole odds of a recession thing in 2022. But then right after, he was basically saying there's no chance for a recession, unemployment, everything's looking too good for that this year. He said we have a very good chance, they think, of seeing a soft or soft-ish recession. So it's like the Fed says one thing, and then they say a soft-ish landing. That's not good. That's implying some level of a recession or some uncertainty about the possibility of a recession. So that really caught my eyes yesterday, or my ears, I should say. I don't know what to call it. And I think that's really playing into some of the market instability today. The whole Europe thing, that's a big problem. The Fed did acknowledge China was an issue to potentially slow down U.S. Economic growth and the economic outlook. So that was not good as well, and that was something new. The Fed has not really talked about China lockdowns at all, and they did yesterday. So I was honestly expecting to see more strength in the markets today, and we did not get that. The shorts are literally in control, whether they are shorting the markets, whether they are just getting margin called and getting forced out of the markets. If you take a look at the term margin call, the only time we have ever been higher since 2004, when Google started to track this information, was during 2011 when the movie Margin Call came out. By the way, if you guys have not seen that movie, check it out. It's a really good movie, but we've never been higher than where we are currently at, and the margin debt is still very, very high. So it's going to be a rocky time in the markets. It's going to be very, very volatile. I suggest, not a recommendation, but just don't look at your portfolio if you're concerned about it. Come back in 6 months, look at your portfolio then, and I'm pretty damn confident 6 months to a year from now, you'll be happy with your decision to stay in your positions. After all, it's not like you're selling out at the top at this point. I mean, you're selling out at basically rock bottom in the S&P or with a lot of other stocks as well. So that is basically that. Let's talk about SoFi stock and what is currently going on today as far as the option activity, the short interest, all of that good stuff. We could see the short interest is sitting at 19.72%. Current shares that are sold short of 143.28 million. Cost to borrow max of 3.14%. Utilization of 100% and days to cover sitting at 3.87. So whenever the reversal does actually come and we can get a solid rally, which could be as soon as May 11th, a potential rally could have more legs to it and could have more momentum, because that's when we get the next CPI data report, and that's going to be very, very important, especially core CPI is basically what the Fed looks at, right? And that's what they base most of their judgments on. That has actually went down over the last 2 readings, and core CPI is inflation, CPI, minus food and energy, because the Fed said yesterday, something that we have known for a long time, but it's really the first time that they acknowledged it, that the Fed cannot control supply side inflation. So it's not really something they focus on. They can't control if food prices go up too much because Russia invaded Ukraine and there's a fertilizer shortage and they're not planting enough wheat, and they control like 30% of all wheat in the world. Fed can't control that. Doesn't matter what they do. They can't bring down that inflation. Same thing with oil, right? Because Russia invaded Ukraine. Or even, COVID lockdowns in China. The Fed can't control that. But what they want to see is core CPI actually going down. And if core CPI goes down again for the 3rd straight reading, that could be really, really good. Fed Jerome Powell said 2 50 base point rate hikes were on the table for the next 2 meetings. And the market started to rally after the Fed said they weren't even looking at a 0.75% rate hike. But overnight tonight, the markets have kind of realized, well, hey, if we get 2 back-to-back 50 base point rate hikes, we're going to be worse off. We're going to have higher rates than if they just did one 0.75% rate increase. So it didn't turn out to be such a good thing to market participants as possibly what it seemed like based off of the market reaction yesterday. Nonetheless, let's get back to SoFi stock. You can actually see a lot of call options that are coming through right now for January 2023. Here's 2 of them. January 19, 2024. In between, even the 250 call for January 2023. $10 call, $5 calls. There's one for October 21st for 61,000. Lots of call activity that is coming in today. There was a lot of put activity yesterday, but virtually everything today has been calls, and you could see 8 orders totaling $1.7 million. Positive order value of 94%. Yesterday it was the complete opposite. Positive order value of 12%, with 5 orders totaling $317.59 thousand. Over the past week, 82% positive order value, 36 orders totaling $9.34 million, and that's probably a reason obviously why SoFi is holding up so well today relative to other things that are not, like a Square that is just absolutely getting destroyed the day they report earnings. Square has earnings in after hours. You do have a couple notable names as well. You have Block, Square, whatever you want to call it, Fubo TV, Lucid, Cloudflare, Opendoor, Wish, DoorDash, Galactic, and Vertex that report earnings here in after hours. And those are going to be pretty interesting. They're not going to be like big market moving earnings, but they will be interesting, and we'll get ideas into how the economy is in certain sectors. So that is pretty much going to be all for this video. Obviously, it goes without saying with SoFi stock, you want to watch that $5 level. If earnings are good, everything is good. You want to watch the moving averages, which hold on, let's go ahead and pull this up. I don't know why it did that, but yeah, 50-day moving average at $8.56 per share, 100-day moving average at $10.97 per share, and then the 200-day moving average at $14.18 per share. Obviously, 50-day moving average, that's $8.56 per share. That's really what you could expect here if we do see some kind of positivity, right? Economic data looking better. Maybe it's CPI, not coming in super hot, core CPI actually going down. That's going to definitely be a very, very positive thing if that happens. So watch those key levels. That is going to be all. I hope this provided you guys some context into what is going on. I would not personally pick a direction. I'm not going to sit here and say the markets are going to continue to crash. I'm not going to say they're going to rip to all-time highs, simply due to the fact the fundamentals have not really changed for a lot of the companies that have already reported. If the markets are going to come down in a substantial way, go under 400 on the S&P, I would imagine it would be because your largest stocks like Apple, Tesla, Amazon, Google, Nvidia, these large players in the economy have really bad earnings, and we just got their earnings out of the way. So the next time you could possibly see that would be next earnings, really, Q2 earnings, and that could be even more important. So that is pretty much going to be all for this video. Hit the like button, subscribe to the channel, source comments, questions, or concerns down below in the comments section. Subscribe to the channel, all of that good stuff. You guys enjoy the rest of your day. I will see you in the next one.